Hello and welcome to this lecture on market breadth. In this lecture, we'll explore what market breadth is, why it is important, and how it can be used to analyze the stock market. Market breadth refers to the degree to which the overall stock market is advancing or declining. It is a measure of the number of stocks that are advancing versus declining. Market breadth is important because it provides an overall picture of the health of the stock market and can be used to predict the future trend. There are several indicators used to measure market breadth, including the advanced decline line and the McLennan oscillator, and the percentage of stocks above their moving average. These indicators can be used to analyze the market breadth in both the short term and the long term. The advanced decline line is a simple indicator that shows the number of stocks that have advanced versus declined on a given day. If the number of advancing stocks is higher than the number of declining stock, the market is said to have a positive breadth. Conversely, if the number of declining stock is higher than the number of advancing stock, the market is said to have a negative breadth. The McLennan oscillator is a more complex indicator that uses a moving average of the advanced decline line to identify overbought and oversold conditions in the market. If the oscillator is above zero, the market is said to be in a bullish phase, while if it is below zero, the market is said to be in a bearish phase. The percentage of stocks above moving average is another indicator used to measure market breadth. This indicator shows the percentage of stocks that are trading above their moving average. If percentage is higher, it indicates that the market is in the bullish phase, while a low percentage indicates a bearish phase. Market breadth can be used to make informed investment decisions. If the market is in a bullish phase, investors may want to consider buying stocks or increasing their exposure to the stock. Conversely, if the market is in the bearish phase, investors may want to consider selling stocks or reducing their exposure to the stock market. Market breadth is an important concept in analyzing the stock market. It provides insight into the overall health of the market and can be used to predict the future trend by using indicators such as advanced decline, McLennan oscillator, and the percentage of stocks above the moving average. Investors can make informed investment decisions. Thank you for listening to this lecture on market breadth.